High-yield stocks have been outperforming the broader market over the past several months, especially since the beginning of July. And this is really because of a growing consensus that the time has come for the Fed to finally start cutting interest rates. Obviously, they didn't cut until September, but already in July, that view had been priced in that, hey, they're going to cut not just a little bit, but meaningfully by the end of the year. Inflation seems to have been tamed, even if it's not coming down as fast as some would like. It's not showing any real signs of accelerating. And there's growing unemployment. It's rising. There are growing concerns about a recession. And so when you factor all that in, plus all the growing geopolitical uncertainty around the world, it's time for the Fed to ease up a little bit and help the economy get through this period of time without having to worry too much about inflation becoming a major problem. Unfortunately, this party seems to maybe have stopped, at least for now. We've seen that in recent days and weeks as high-yield stocks like REITs and utilities that had led that rally higher have pulled back a little bit. And this is due to some bad news that just recently came out, namely that the jobs report in September illustrated that the jobs market is still pretty strong, that the economy is not likely headed to a recession, at least in the immediate term, and that there is concern about inflation potentially jumping back up. So in this video, I'm going to discuss the implications of this for the high yield sector, as well as individual subsectors within the high yield space, and how I'm positioning my high yielding portfolio as a result. Before we get into the video, if you could please give it a like, I'd greatly help in its distribution. I'd really appreciate it. Thank you so much. Okay, so is this bad news for the high yield sector? Well, yes, it is, because high yield stocks are viewed as bond proxies largely due to their long duration, stable defensive cash flows, the high income yields that they tend to pay out. For example, REITs and utilities pay much higher dividends than, say, a tech stock like Apple or Microsoft. And their cash flows are long duration, fixed due to contracts, regulations, power purchase agreements, leases, etc. And so whether it's a pipeline or a port or a triple net lease rental property or a utility company, they all generally have these long duration cash flows. And so when interest rates rise, that means the average yield you can get by buying a bond goes up, which means that the market in turn expects a higher dividend yield from high yield stocks, and therefore their prices come down. Now, the reason that they're considered bond proxies is simply due to the fact that a lot of these companies, a lot of these infrastructure companies, real estate companies, etc., they make a lot of investments. They're capital intensive businesses. They buy new property. They invest in capital expenditures to expand a pipeline or to increase their electricity generation or distribution capabilities at a utility, etc. And all that capital investment is often funded at least partially with debt and partially with equity. In some cases, they have to issue equity and debt. In other cases, they just have to issue debt. In some cases, they're not issuing any new stuff, but they just have to refinance existing debt that's coming off their books and having to refinance it. And so when interest rates rise, the stock price comes down, so their cost of capital goes up and their cost of debt goes up. And so that's also another headwind for them, that their profit margins will probably shrink some in a higher capital cost environment. And so that's another reason why the stocks get beaten down some in this kind of environment. Of course, it's not all bad news for the high yield sector. You have BDCs, which invest primarily in loans to middle market companies that are floating rate and they're indexed to short-term interest rates. And so when the Fed hikes rates, their yields on their investments go up. When they cut rates, their yields on investments go down. And so that's why over the past few years, BDCs have outperformed REITs and utilities, for example, because those rate hikes, which have been a headwind for those other high yield sectors like we just discussed, were actually a tailwind for BDCs, especially because it was accompanied by a solid economy, so there were very low defaults and non-accruals in the BDC space. But now the Fed has pivoted towards rate cuts. That's going to be a headwind for BDCs, and that's why they've underperformed recently relative to REITs and utilities, because again, when those short-term rates come down, their profit margins, their profit spreads decline. But this is good news for them, obviously, because again, this higher jobs number than was expected, unemployment ticked down a little bit. Wage growth was also really strong. It increased 0.4% month over month, which annualizes about 5%. And that's well above the rate of inflation that the Fed wants and that is currently there. And so that's an inflationary story. And if that persists, inflation may spike back up again. And so that's a little bit of a concern to the Fed. And so since both sides of this mandate trying to pursue full employment while trying to keep inflation down at their target level of 2% or lower, both of those mandates are being impacted by this number in a way that points to higher rates for longer, at least no more cuts for a while, or at least fewer cuts than originally expected. We'll see what exact course the Fed takes. It'll depend on a lot of other data that comes out, of course. But all these things are good for BDCs because a strong economy and higher inflation means that BDCs are going to have fewer defaults and higher interest rates on their investments, whereas for REITs and utilities and a lot of other high yield stocks like infrastructure, et cetera, that's bad news because it means higher cost of capital. And since they're so defensive anyway, if anything, they are a more attractive place when the markets are fearing a recession because they want to go into more defensive names that are going to be less impacted by economic volatility than, say, some of these other more aggressive names. And so that's really what's going on. So what does this mean for my portfolio? Well, before I get into that, if you could please subscribe to my channel, I'd greatly appreciate it. Thank you so much. So how am I positioning my portfolio? Well, right now, I'm not completely abandoning the BDC sector, okay? I've been underweighted for a long time. I will remain underweighted because I still do believe that the overall weight of the evidence points to the Fed continuing to cut rates and concerns about an economic downturn. However, this could be a symptom that good times are here to stay for a little bit longer for the economy, that inflation is not going down anytime soon, which honestly wouldn't surprise me if my personal view is stagflation. But, so I think that BDCs are worth holding in a portfolio. That said, because I do expect stagflation, I still want somewhat defensive names that have a margin of safety built into their valuations, that are invested primarily in senior secured loans, that have solid workout teams in place. So they should be able to do okay during a recession. And if inflation remains a little bit higher through it, Fed may not cut as aggressively. And so that will prop them up, a nice source of income, portfolio diversification. But at the same time, I am also investing still overweight into REITs and utilities and infrastructure companies at large, really more so than even utilities. And because the reason for this is I really want companies, and the REITs and infrastructure companies that I'm picking, by and large, have very strong balance sheets, defensive business models, because that will enable them to weather an economic downturn in a stagflationary environment. And they also have business models or contract structures that make them pretty resilient in the face of higher inflation. And the reason for that is because, again, in a stagflation environment, I expect inflation to remain at or above the Fed's target rate for some time. And so, that's names like W.P. Carey that have majority of their rent coming from leases with CPI-linked escalators. So that means when inflation remains higher for longer, their rents are going to grow faster each year in line with that inflation. And so that helps organic growth to increase with higher inflation, which will help offset the headwinds from their higher cost of capital. Meanwhile, the triple net lease business model makes it a very defensive business model. REITs like high quality Class B apartment REITs with strong balance sheets like BSR REIT I've discussed in the past. That's another good option because they're short-term leases, and markets with strong demographic growth mean that they should have some pricing power. If there's high inflation, they can quickly roll over those leases to keep up with inflation, while their strong balance sheet will protect them as well. Or obviously infrastructure companies like Brookfield Infrastructure Partners, Brookfield Renewable Partners. Again, if you don't like the K1s, you can buy the corporation equivalents of those. But they invest in widely diversified portfolios of infrastructure that have defensive nature, but also have those inflation-linked escalators on their contracts that make them good in a stagflationary environment while also boasting a strong balance sheet. So there you have it. That's how I'm personally setting up my portfolio to navigate through this time. I'm not abandoning the BDC sector because we could have a situation where the economy remains at least somewhat stable and inflation remains a little bit higher, and that's going to be good for quality BDCs. And I'm also playing the stagflation game in my REIT and infrastructure portfolio by, again, having quality businesses with defensive business models, but that also have some inflation protections built in as well. So if this video is helpful to you, again, if you could like it, subscribe to my channel, let me know in the comment section below what you liked about it or what you didn't like about it. I'd be greatly appreciative. See you next time. Thank you.